Welcome to the Money Show, your one-stop shop and the only show of its kind where we get to answering all of your personal financial queries and get to you, the market's top financial experts, to answer your queries. I'm Mubina Kapasi, and let's kickstart the show by introducing the expert we're going to be having with us for the next 30 minutes. It's Feroz Aziz, the Deputy CEO of Anand Rathi Private Wealth Management. Thanks so much for joining in right here on the show, and let's first introduce the topic that we will be discussing this evening. Crores lie unclaimed with insurers, and here's what we want to do on the Money Show: help you find out if any of it is yours. Because do remember, we have had a lot of data coming by thick and fast about unclaimed insurance money only on the rise. In fact, as on 31st March, we understand more than 15,000 crore rupees of policyholders' money has remained unclaimed with 23 life insurers. Out of the total unclaimed, we have LIC itself that has more than 10,500 crore rupees, and the balance 22 private sector insurers have a neat 4,657 crore rupees. So right here on ED Now, we want to help you claim that policy money, which is of course rightfully yours. And let's kickstart the show by answering all of the viewer queries that we have received right here on ET Now on insurance. First up, we have Manoj Tiwari, who has sent in her question. Manoj says that he is salaried and aged 35. He wants to know which is the best term insurance in the market. It's important, of course, to understand all these details because age would be a prime factor on what sort of term insurance would be suitable for you. Additionally, of course, it also depends on your health. But let's understand first then from Feroz on what are the other parameters he should consider and what sort of a term insurance would be best for him. Feroz?
Mubina, I think Manoj should look at term cover. The first point is I think he has chosen the right vehicle to use insurance. Quite a few people digress into ULIPs and endowment plans which try and club investment and insurance. I think for every viewer, Manoj Tiwari's strategy of buying a term plan, to my mind, is the best suited. Now coming to how does he make a choice, I think one is, of course, the claim settlement ratios is an important item. How well has the insurance company settled all the claims which have been done in the past is very important. Point two is you'll have to figure out what kind of term cover do you need, which I think is very important so that you understand your need in terms of your insurance requirement. To my mind, as a thumb rule, it should at least be equal to 10 times your annual salary. Third is, of course, the cost you pay, because term cover is a commoditized product. There is no expectation of a return from it. So lesser the premium, the better it is, as long as you've created you've checked the settlement ratios of that specific company. And lastly, if you buy these term plans online, because you're eliminating one layer of a broker, the cost comes down substantially. So buying it online could be a very, very good strategy.
Okay, so that's an interesting tip as well. Buying it online, yes, it will help you save those costs that do go through to the middleman. Let's move on to our next question. It's coming in from Kabir Lamba. Now, he says he is in his early 30s, a first-time investor in mutual funds. He started an SIP, in fact, of about 10,000 rupees through Funds Bazaar, and he's investing for wealth creation. So naturally, he's going to be investing from a longer-term time horizon. And at this point of time, he wants to take only moderate risk. Though the fact that he's in early 30s means that his risk-taking ability could be a little higher, but nevertheless, it's his own personal choice. He wants you to review his portfolio and whether it's good enough for him to achieve his goal. So he has L&T Emerging Business Fund. It's the growth plan, and along with that, he also has the ICICI Prudential Balanced Fund. Once again, the growth plan. Feroz, what would be your take on these two mutual funds, given his, of course, longer term time horizon, given his younger age? What would you believe? How would you rate his current mutual fund or SIP portfolio?
So Kabir's portfolio comprises of two funds, so it's a simple portfolio. I think age is on his favor, so compounding can come to his rescue when it comes to making money and creating wealth. So that's the good news for Kabir. Point two, he has chosen growth options in both these schemes. I think it's a good point to highlight to all viewers. After 1st of April, when dividend distribution tax has been reintroduced on the equity side, choosing a dividend payout or a dividend reinvestment option would not be a very wise thing. So choosing a growth option, to my mind, is the most prudent. Then coming to specific schemes, one is the L&T Emerging Business. It's one unique fund which has about 5,000 odd crores. It has two fund managers, one of the few funds which have two brains working, which is more than one. So Mr. Desai and Larry, who are the fund managers, have done a brilliant job in terms of bottom-up stock picking, so he can continue holding that scheme. When it comes to ICICI Balanced Fund, not very happy with it, because not just because of the return being lower, but the risk taken for the return which has been given is on the lower side. So you're taking more risk and not getting the commensurate return. So that can be replaced with Mirae Asset India Equity Fund, which to my mind from a future perspective would do significantly better than his current holding.
Okay, so a small chop and change recommended by Feroz when it comes to the SIP selection as given by you. Moving on, we have a third query coming in from Tushar Kelkar. He says he has 40 lakh rupees that he received after selling his parents' house, and he wants to know that if he does indeed wish to go for a mutual fund, which one would you suggest? And he's also looking for a regular income out of the investment. Feroz, I mean, definitely he would like something that does give out a regular income. So I suppose fixed income kind of schemes would be beneficial for him. But again, you know, a mix perhaps would help him create some wealth as well.
Yes, I think. See, you every expectation from money, especially on the regular income side, puts burden on the money to underperform the possible potential growth the money can realize. So you'll have to try and see what kind of balance which needs to be created on creating wealth in the long run, and also trying to take care of the need of a regular income. So Tushar, what you should be ideally doing, if you're listening, is the fact that you should split this money, like Mubina said, into two portions. One large portion should be on the growth side, which is on the equity portion. 70% should be on equity and 30% should be on debt side. If you so did it, you can have an average return of 13-14% over long periods of time, and that could be a very beneficial thing because you will beat inflation hands down. So point one I'm making is asset allocation 70-30. Point two, to get your regular income on the debt side, you can use a phenomena called systematic withdrawal plan, which will be tax efficient and also give you a monthly credit to your bank account on a monthly or a quarterly as you desire. And on the equity side, let me recommend some funds for you on the 70% if you agree with the asset allocation. Mirae Asset India Equity, Kotak Standard Multi-Cap on the large cap side. On the mid cap side, Franklin India Prima and Canara Robeco Emerging Equities. And on the small cap side, HDFC Small Cap Fund, if you made a portfolio of these 5 funds on the equity side. On the debt side, you can look at a Franklin Dynamic Accrual Fund and a Franklin ICICI Regular Savings Fund. These 2 funds on the debt side, 5 funds on the equity side for your 40 lakhs, because it's a lump sum amount, is a good thing to do.
All right. So that's of course quite a curated description given by Feroz on how you can go about when it comes to investing in mutual funds. But of course, here's a call to all of our viewers. If you do have any such questions and queries in relation to personal finance, we are going to be having financial experts that will be answering all those questions and queries. You can email us on the Money Show at etnow.tv. You could call us on the number flashing on your screen. That's 022 675 7594, and you could also in fact tweet to us. So all these options and methods are there, and we'll of course be right here to answer all of your questions and queries. But like I said, the topic that we want to discuss is about the crores of rupees that have been lying unclaimed with insurers. LIC, Feroz, like I mentioned, had more than 10,000 crore rupees of unclaimed policyholder money that's lying with them. Subsequently, of course, the RDI has directed that this money be redirected to another fund. So how exactly could viewers find out if they have any unclaimed policy money that's lying with their individual insurers? Because at this day and age, yes, you may consider buying an insurance and you may do so via the multiple modes that are there online, etc. But the tendency for human nature is to essentially forget where you have allocated your money, especially when you already are so busy in your daily life. So how to ensure that you rightfully are able to claim your policy money?
See, Mobina, I think it's a very important topic. If that kind of monies which are remaining unclaimed of people, that's hard-earned money. So laying your hands on it is critical, point one. Point two is, like you rightly pointed out, when you are buying so many products from different people, different agents, it's bound to happen that you will there will be slippages and you will miss a couple of them. So to identify it, you will have to look at all your Form 16s and your declarations you have given to your employer. For example, if you have been a salaried employee, it is but natural that if you have made these insurance policies, you would have claimed an ATC benefit. So you have to go to your tax returns and figure out whether some of the policies have been missed in the entire journey of managing money for yourself. Point two is you can ask for a consolidated statement, not just for insurance, but there is about 10,000 crores, 11,000 crores of unclaimed mutual fund deposits. So you should try and do both of these by using a consolidation service given by NSDL and CDSL. In a show like this, we can only create curiosity for the viewer, for him or her to do homework. CDSL and NSDL gives you consolidated statement on a monthly basis, across different brokers, across different trading accounts, across different demat accounts. So that consolidation actually helps you discover some of the lost folios on the mutual fund side at least. So this is what you should do. Like Mobina, you mentioned, if the money is not claimed within 10 years of it being unclaimed, it goes into the benefit of another fund which is directed towards senior citizen benefit. So you will lose that forever. So you will have to be vigilant and wake up to this phenomena that you might have some of your money lying around and lazing around doing nothing for you.
Okay, Feroz, thanks a lot. And yes, it's a tip that everyone must take note of. Do not let go of policy money that's rightfully yours and ensure that you do so as soon as possible. We'll take a very short break right here on the show, but come back as we answer more of your personalized individual financial queries. Welcome back. You're watching The Money Show right here on ET. Now we have with us right here on the show Mr. Feroz Aziz to take us and to give you curated answers on all of your questions and queries. First up, Mr. Aziz, I want to just, before we progress any further with questions and queries, I want to talk about one mutual fund that's caught our eye, and that's the SBI Blue Chip Direct Plan. It essentially invests in large cap equity stocks. The assets under management currently are at a little over 19,000 crore rupees, and interestingly, on a year-to-date basis, it's just been about okayish with a 0.9% rise. But the last 1 month, and just like the markets as well, we've seen a 4% rise coming by. And in the last 1 year, it's given a return of about 5.7%. Blue chip companies in its portfolio, so the likes of an L&T, HDFC Bank, M&M, ITC, Nestle, the bluest of the blue chips, of India Inc. is what it contains in its portfolio. How do you like this fund in terms of the constituents, in terms of the returns as well that it has given? Because given the fact that it has all these large cap names which have essentially been driving the rally as well in the markets, the performance would just be about okayish. So how do you view this fund? What's your rating on this fund?
See, Mobina, I think the rating of this fund specifically as we stand today and the contemporary situation, also looking forward, not just backward, it would be 6 out of 10. It would not be one of my favorite funds. Of course, it was very good. Over the last year and a half or two, it has lost the plot and actually not performed really well, because 1 year performance has been 5.73 for 1 year, but the category, the rest of the funds in the same category have done almost 12%. So it has underperformed the rest of the category by as large as 6-7%, and that's a huge underperformance. Sohani, who is the fund manager of this fund, who is a very good fund manager, unfortunately the size of the fund has become a deterrent because it's grown multifold in terms of size. And secondly, I think the expense ratio is marginally on the higher side, and I think they have definitely not participated in the stocks in the blue chip side, which have taken the Nifty as high as it is today, the highest ever. So point I'm making is 6 on 10 is what I would give on the direct plan of SBI blue chip. And the SBI category, I have other choices which would be significantly better. To just name one, SBI emerging business could be another replacement if you are a part of this 19,000 crores.
Okay, so that of course is the view when it comes to SBI blue chip. Feroz not very impressed because unfortunately the stocks that it does have in its portfolio are not the guys that have actually contributed to this record rally that we have been witnessing on the Nifty. So a bit of misfortune is well coming by for an SBI blue chip. Well, let's get on board with more viewer queries. Then first up we have Shakti Vesh from Chennai, who is joining us live on the phone line. Hi, good evening. Thanks for calling in on the Money Show. What is your question for Feroz?
My question is, will switching from equity to debt scheme of the same fund will attract any tax implications?
Okay, interesting question, especially coming in at a time when there have been changes to tax regime. Shakti, very quick questions. How long have you been invested in the equity scheme? Oops, I think we have lost his line. But yeah, Feroz, I'm just going to toss over that question to you. What would be the tax implication if an investor essentially switches over within the same, fund house from an equity scheme to a debt scheme?
So he or she will have a tax implication in spite of it being under the same fund house. Even if you are in the same fund house, this switch triggers a sale of a specific unit and a purchase of another unit. So there will be tax implication, point one. Point two then comes, what is the extent of tax implication, for which Mubina's very important question of how long has the investor stayed invested becomes the critical question. So if you've crossed 365 days, it becomes long-term category and your tax will be 10%. If you have not finished 365 days in the equity category of the fund, then your tax will be short-term in nature, not long-term, and that will be taxed at 15%. And then the last point, fortunately in this budget, you were provided as an investor a benefit of grandfathering. So it is unlikely that you will be taxed if you switch now, because most of the mutual fund NAVs are lower than the level at which you have been given an exemption of 31st January 2018. So point I'm making is, when you make a switch, you will have to make a switch post 365 days to get the best tax. And if you are switching now, you have already been exempt for the tax of long-term category till the NAV's level of January 31st, 2018. So calculate as per grandfathering clause in the finance bill of this budget.
Okay, articulately explained by Feroz on what exactly would be the tax implications and how exactly could you go about planning when it comes to making this transition to minimize your tax impact. We have another caller joining us right now on the phone line. It's Cyrus. He's calling in from Mumbai. Cyrus, hi, good evening. What's your question for Feroz?
Yeah, hi, good evening. Feroz, the question is split up into two parts. I am already doing a SIP of ICICI Focus Blue Chip for about 30,000 and IDFC Premier Equity Fund for 20,000. So the one is, how are these funds? In fact, they have given me a substantial amount of returns in the last 2 or 3 years. That's question number one. Second is, I'm looking to invest close to about 35 lakh rupees and looking at the balance fund to have a steady monthly income which can offset my EMI of the house. I have been recommended 4 funds: HDFC Balance Fund, L&T Hybrid Equity Fund, ICICI Pro Equity Fund, and SBI Equity Hybrid Fund. So, and I've been asked to divide my money between these 4 or 5 funds, so I can have an income close to about 25 to 30,000 rupees on a monthly basis.
Okay. Feroz, over to you on that one.
Correct. Yes, so quickly, Cyrus, point one, both your funds, one is the ICICI Focus Blue Chip Fund. It has become a reasonably large fund. I would personally ask you to stay away from ICICI Focus Blue Chip. You can go to another fund which is called the ICICI Top 100. It is under the same umbrella. ICICI Top 100 would be a better fund from the new regime. After October 17th regulation of SEBI, the prospects of ICICI Blue Chip would be lower than Top 100 because there is a large change in the construct, the way these funds are constructed. So a marginal change in the ICICI basket, similar portfolio, but that will be a better performing portfolio in my opinion, about a couple of % a year. Point two, IDFC Premier Equity, you should exit because there is a change in the fund manager over the last year and a half. Kenneth Andrade, who was the fund manager, moved on, and that has actually created a slip in the portfolio's performance. Of course, he's been replaced by another fund manager, the CIO called Anup Bhaskar from UTI. He has moved there. But I would definitely not want to be a part of this transition in the strategy and would like to have other funds which are more stable in nature, especially on the fund manager side. So that's point two. Then coming to your balance fund recommendation, of course the balance funds which you mentioned are good balance funds, but you will have to remember that going forward the dividends which you get from balance fund would be deducted for tax to the extent of 10%, and they were exempt from dividend distribution tax up to April 1st. Now they are being taxed, so it might not be the most prudent way to fund your EMIs. You might want to create an asset allocation and use a systematic withdrawal plan and speak to your advisor and say, give me a systematic withdrawal plan. I will take my equity exposure on pure equity funds, and from the debt portion use a systematic withdrawal plan. That will be a better option than a dividend on the balance fund.
Okay, there you have it. Customized solution to all your financial queries, as given, of course, by Feroz right here on the show. Well, next up, we have another question coming in. This time it's from Akshay. Now, Akshay says he has been investing in Reliance Diversified Power Sector Fund for the last 8 years, and now he wants to switch over to another fund. He wants to know some names, and he preferably wants to stay within the Reliance Fund House. So, Feroz, any other exciting names within that fund house? For Akshay to invest in, for him to move over from the power sector fund that Reliance has?
Correct. I think firstly there's from Akshay's query there's a learning for people who are the viewers or investors, is that if you hold a sectorial fund like a power sector fund for 8 big years, your returns would automatically come closer to a normal fund, but the risks would be significantly more. So holding a sector fund is a short-term affair. If you hold it for long periods, you will not be rewarded for the extra risk you took. Point one, Akshay. So I'm very happy that you're actually now contemplating a switch into a more diversified kind of a fund from a power sector fund. Better late than never. Make that switch. If you have some affinity towards staying under the Reliance umbrella, you can look at Reliance Large Cap Fund, which was earlier called Reliance Top 200. That will be, in my opinion, in that basket of funds, the best one, because it has about Nifty as the underlying and has about 82% invested in large companies. So it has stability and has almost about a 50 stock portfolio. I would vouch for a Reliance Large Cap Fund as it is called now. So in the previous avatar, it used to be called as the Reliance Top 200 fund. So I think that's the switch you should be doing if you're looking at the next 3 years, 4-year time frames to make some degree of growth on your capital.
Okay, I hope, Akshay, that has answered your question. Feroz, I'd like to thank you very much then for joining in on the Money Show, giving your customized solutions for all the plethora of questions and queries that our viewers have been sending in thick and fast. And please do not stop sending them. We will be having our financial experts right here on the Money Show answering all of them. The Times Network and the Association of Mutual Funds have, of course, the Jan Nivesh Investor Education Initiative that is getting people to pledge to invest just a day's income into mutual funds for long-term benefits. And you too can be a partner of the growing Indian economy by investing in mutual funds. So join the Jan Nivesh movement. Give a missed call on 1800 833 666 to pledge to invest your one day's income into mutual funds. curtains down on this edition of the show. Thanks for watching. Come back tomorrow, same time, same place. And of course, keep sending in your questions and queries. Stay tuned to ET Now.